We know about what's happened with Alphabet, up 10% alone this week. Amazon had a great week as well. And then year to date, these stocks are the ones that everybody's been talking about for all of the obvious reasons. They're up, in most cases, minimum of 30 some odd percent. And in some cases, like Meta, a double. 100%. So what now? What now for these stocks?
Well, I think nobody, even the bears, would say that these stocks are up for no reason. The fundamentals, while not as hot as they were in 2021, are pretty good, I would say, across the board. It's not high growth anymore, but the good news is that's not the expectation. These companies have done a great job passing on costs to consumers. They've done a great job focusing on the areas of their business that still are in a secular growth mode. They've laid off employees, which Wall Street loves, perversely, and they've basically done a better job at returning capital to shareholders than companies in almost any other industry you could think of. You're talking about dividends, you're talking about buybacks. So this is why I think these stocks can remain okay. I don't know that we're going to see a repeat of the performance we've seen year to date. It'd be pretty hard to do, given the market caps.
I mean, you got a year's worth of gains in the first, 4 or so months, but you're not painting a picture that sounds very much like you think these stocks are going to give a large portion of what they've done so far up.
Well, here's where I'm going with this. So you're going to sell them, and what are you going to do? If you tell me, well, I'm going to sell them and I'm going to earn 5.25% cash in an account at, I don't know, Public or Flourish or one of these apps, okay, that's an answer. I'm going to own T-bills. That's an answer. I don't hate that. You're just basically changing the risk profile of what you're doing with that bucket of assets. If you tell me I'm getting out of these and I'm going to start buying heavy machinery or deep cyclicals, I'm not for that trade. I'd rather stick it out with large cap tech. The devil you know better than the devil you don't. And we're not getting the kind of economic news that I think would make you want to look for cyclical exposure. So I think that's why people are staying put. That's where they are. So far, so good.
Obviously going to go to Jim right out of that, because you have been looking for more cyclical exposure and urging our viewers to do just that at the expense in large part of tech.
Yeah, it's a question of degree. And this is not at any point have I said sell all of your tech and go to cyclicals. I own Alphabet. I own Apple, just as an example.
It's not even a matter of selling and go to. It's simply being predisposed to say I favor these over those.
That's exactly right. That's exactly right, Scott. Perfect. Thank you. And I like what Josh just said. This isn't oh my God, these stocks, the FANG stocks are going to suck from here. That's not the comment at all. But I think we need to look at what the numbers actually are, right? Just take Microsoft and Apple together. They're about 14% of the S&P 500 market cap weighted index. Generally speaking, you have to ask yourself, where do you think the next, 5 percentage points of those two are going to be? To the upside or to the downside? Personally, I think it's to the downside. Not because they're terrible stocks, but because in my thesis, which most people know, you've got better economic growth coming from the hard asset sectors, industrials, as we're building factories, as we're building infrastructure, as we're catching up on industrial production from the Boeings, GMs, and Fords of the world. By the way, Scott, Josh, Anastasia, everybody watching, I could very well be wrong. I'm not saying I know the future with certainty. What I'm saying is this is how I read the tea leaves. I see better earnings growth from the industrials, energy, and materials. That's why I'm favoring it.
Can I just one thing, and then I know we're going to go to Anastasia. I'm sorry. These stocks don't have to go from 14% to 20% of the S&P. It's conceivable that they could. It's happened before. But what's actually supporting these names are buybacks. So you actually could have them, from a market cap perspective, remain static. From a index construction perspective, not get any bigger, but have the stocks continue to work. These are two of the biggest buybacks, maybe of all time.
Yeah, just a coda to this before we go to Anastasia. Yeah. I want to make this clear. I'm not saying that Apple and Alphabet are terrible stocks. I own them.
We got it.
I'm just seeing, in my opinion, and everybody knows my reasons why, I see better return potential going ahead, going forward from those cyclical sectors. That's why I favor it.
Okay, so I want then Anastasia, before we get to Weiss, to settle it.
Sure, that's a good debate, and I settle out with Josh on this one for now. I think this is not an accident that big tech performed the way it did. I mean, you think about about the earnings growth potential, I just looked at the big FANG stocks today, and I looked at the 2-year average earnings growth that's expected from them. It is double digits, between 15 and 23%. Where else can you find that in the S&P 500? You probably can't. If you look at the balance sheets of these stocks, of course, they don't have the leverage that some of the other companies have. If you look at small caps, for example, there's a lot of floating rate exposure there. That's not the case with some of these big tech companies.